Hello everyone. Okay, let's tune in to another episode of the ETF. This time we're gonna talking about the iShare Morningstar Small Cap Growth ETF, ticker symbol ISCG. Okay, let's get a disclaimer away first. Everything I said does not constitute investment advising. I'm not giving investment advising. I'm just talking about the fund. And investing involves risk. If you want to invest, do your own homework, do your own research. I'm not here to giving the investing advising. Okay, let's do this. The fund description: iShares Morningstar Small Cap Growth ETF, tracking the U.S. market, small cap. So they focus on a small company in the U.S. market, and they focus on the growth. Select the metrics such as the above average earnings, sale, cash flow, book value growth, and so on. And so they focus on above average earnings. So those are growth stop, not value stop. So you're gonna expect it has a high valuation, high PE ratio. It's only target US small cap. So it's domestic company focus on the small company in the United States. All right. Let's take a look at the chart. Gross hypothetic 10 grand. You put a 2004, you put a 10 grand in, you got like 70 grand on the 26th, March 26th. So not bad, but it's relatively similar to a larger cap. So, but you take the more risk since this is small cap has more like volatility. Look here. Now during the COVID, they have big dip right here during the COVID 2020. And that's what you have to handle on. This is buy and hold strategy. If you can't handle volatility, you're better off investing in bond or blue chip, larger cap, S&P 500. So this is index fund, very close follow up the benchmark. So, which is good here. And let's take a look at the calendar years. 2021 we got a negative 1%, 1.25%, 1.25%. 2022 negative 26%, 23%. So there's large. Actually, the ETF go down dramatically on the 2022. So that's the thing about small cap. So if you are somebody really sensitive to this kind of volatility, go down 26%, you have to make 40%, more than 50% to get money back. Just get your money back. All right, if you invest in 2022. So that's something you want to consider: is the volatility right for you or not? And let's take a look at the long-term average annual performance. 10-year average 10%, pretty much the same as the S&P. I think the S&P even do a little bit better than that, but actually pretty much the same. So 10%, and the average is 5 years 2.6%, 3 years 12%. So you hold for only 5 years, you only get 2%. So this is buy and hold strategy. Hold 10 years, get 10%. So eventually you double your money, triple your money if you hold it for the long run instead of the short run. Here's got a top holding. All these companies, Lumen, ITT Incorporation, Clean Harbor. Yeah, it's weight based. They don't. I'm not sure this company is weight based, but it look like that they equal weight. They don't invest in particular company too much, but this is weight based, basically on the size of the company. The sector they are invested in, so they are heavily investing in industry, right? The industry growth is particularly fast. Industry, information technologies, that makes sense. Right now, it's the aging of the technology, AI, robotic. So a lot of small company, startup, startup company focus on heavily in the information technology. Also, because the aging population in the United States, the healthcare industry is booming. After that is 10% the financial consumer discretionary. Back to the healthcare, we are not just talking about the pharmaceutical industry. We are also talking about the nursing home, right? The industry making a doll diaper because the aging population, doll diaper will sell very well in this type of demographic and this type of not demographic, this type of aging population in the United States. All right, let's take a look at the Morningstar rating here. 3-star rating. I don't know why they call it Morningstar. Small cap company got a 3-star rating for the Morningstar. That's pretty funny, right? Against the 500, okay, this is iShares with against the 522 small cap. Okay, a risk-adjusted return. The Morningstar is just something you can take a look, and it's not like 100%, but you can take a look, just give you some idea. There are a lot of rating, different website, different financial website, different financial, independent financial website have their own rating on different ETF. You can take a look, but ultimately you have to decide for your own. You have to study what type of company you are invested in and what type of investment objective you have. Rating is not that, in my opinion, rating is not that important, depending on the individual's needs. Asset class equity, of course, small cap growth equity. So this is growth extended index. So they focus on the growth. What happens is they are focused on the growth. They are not valuation, not value stock. So you expecting very low yield. Distribution quarterly. They trade on the New York Stock Exchange. Okay, expense ratio. This is pretty low expense ratio, only like 0.06%. So that's you invest $100, you only pay 6 cents for every $100 you invest in this fund. So that's the fee, management fee. And the other expense put together just 0.06%. So that's really, really low. And fund characteristic. Look here, 30 days SEC yields like 0.74%. That's extremely low. Okay, this is growth stock for the company. Just a startup company, a lot of small company. They don't pay dividend because they're using all the money they earn, all the profit they earn, put back into the business to continue growth. That's why they have high earning. That's why they're growing faster than other company, than other like mid cap or large cap company. So this is what's expecting here is 0.74%, very low yield. If you're looking for the income, probably this is not right for you. If you are young, just start work, you get a 401k. Well, small cap growth will be something you want to look into because you have a very long time horizon, and historically, in the long run, the small cap will perform the large cap and the mid cap, but there's no guaranteed. But just look at the 30 years, 50 years historical data and chart. You can see they outperform the larger cap and mid cap because they are the small company. They grow small. PB ratio. So, let's take a look at the equity beta. Equity beta, you want to equity beta one is you want to equity beta means the volatility of the fund. All right, how risky is the ETF? All right, above 1 is get a little bit risky. Below 1 is less risky, but it's all depend. In the long run, those risks can be averaged out if you can buy and hold for 30 or 40 years. So that's up to you. PB ratio, price to book ratio, 3.3. This is pretty high. So a lot of small companies, they have to borrow money right? They are startup company. They have borrowed money from bank, the private loan, stuff like that. So they are heavily in debt. So some of them not gonna make it. They're gonna go away. They're gonna go bankrupt. They're gonna be out of business. But the good thing is this is index fund. So once this the company get out of business or losing and well the business, their other company will be replaced in the index. So that's not a big issue. You still have a company to invest. Not, a lot of company to invest. This fund, this ETF holding a 960 company, a small cap company in the ETF. So that's good. And the PE ratio, look, this is gross small cap, so the PE ratio has to be relatively high. So small cap company usually have a high PE ratio compared to a larger cap company, and the growth company usually have a high PE ratio. Value company, okay, value cap company. You're looking for the growth. You are not looking for the low valuation. So that's something you want to really look into. 18%, that's the volatility of the fund. All right, here we go. This is the ISCG, iShares Morningstar Small Cap Growth ETF. Here we go.